Hello, how are you once again? Welcome to this channel. My name is CP Otieno, and today we want to take our lesson 5, and I want to call upon those of you who have not had any opportunity to go through our first lesson, the second, the third, and even the fourth lesson. Kindly get some opportunity to go through those lessons so that you can at least catch up with whatever we want to do in this fifth lesson. In our lesson 5, we are handling the profit and loss account, which is also known as the income statement. It is also known as the financial performance. This refers to a statement which provides a summary of the revenues, costs, expenses incurred during a particular period. It is one of the financial statements of an organization which provides details of the organization's financial performance for a given period. The items to note here: number one, we are talking about the particular period. The other thing that we are talking about here is that it is a statement which gives the financial performance of the organization. So if you can see the financial performance for a given period. In simple terms, if you are asked to define this one, even without referring to any document, you just mix these two items here. The results in terms of financial performance within a given period. It is the financial statement of an organization which gives a picture of the financial performance of an organization within a given period of time. Allow me to introduce the format of a statement of financial performance. This is the format that we are going to use. We are not going to use the format of a T account, the way some of us would expect, but we are going to use an advanced format. Now we should be having the name of the company, followed by the name of the financial statement, followed by the period covered. Under the title there, we have Bestie Traders Limited, Statement of Financial Performance for the period ended 31st March 2020. The first line item that we have there is indicating the organization. The second line item is indicating the type of financial statement. Then the third is indicating the period that we are talking about. It is important to indicate the currency that we are talking about, or the currency in which the operation of the business are conducted. It is that statement that tells us whether the business is gaining or it's losing in the process of its operations. A business can either make sales on cash terms, or it can also make sales on credit terms. So the sales that we are having here is a combination of the two, because we are working with the accrual concept. The statements that we are talking about here are prepared based on accrual concept. We shall cover the income that has already been received and that income that has been earned but is expected to be received. The income that has not yet been received but has already been earned. You remember we talked about the accrual concept. That is the concept that allows us to use that kind of treatment. As we go ahead, we are going to have the sales, then minus returns inwards. We have the sales. That is the revenue that has been earned as a result of selling the products of the organization. Then we are supposed to less returns inwards. So returns inwards in this case refers to the goods that have been sold out, but because of one reason or another, they have been brought back to the business by the customer. So if goods have been brought back and they had already been sold out, it means it reduces the quantity of sales. For example, if the customer was to pay us $100, then goods worth $10 have been brought back. It means that we only expect $90. Definitely the value of sales or the revenue that we expect will go down. So, and that's why we are having here sales. We are supposed to deduct the returns inwards. And I've said that returns inwards is the value of the goods returned to the organization after the sales have been made. And that's why we are having here sales minus returns inwards, so that you can have the net sales. Thereafter, you're supposed to be having the cost of sales. This one will give us a total cost of goods that were sold so that we can match it against the sales revenue. If you match that against the sales revenue, then we should be able to get what we call the gross profit. This is how we are going to calculate our cost of sales. We have the opening inventory. We have the stock value that has been brought down from the previous financial period. So that stock figure that we have opened the business with, we are supposed to add on top of it, we add the purchases that we've made in the current financial period. And then there is also this cost that it comes with. If you want to know the value of purchases that you've made, let's say you want to import a certain product, and then when that product comes, we have got some associated costs to that particular product that you are trying to import. So that cost that can be attributed to the purchase of that particular product will be forming part of the cost of the product. If you wanted to import something like a book and the total cost of that book is $5, and maybe the cost of transporting that book from the supplier to where you are is around $1. So you add the $1 to the $5 so that you get $6. So in that case, the total cost of the product, or rather the total cost of the book that you've purchased, will be $6 and not $5. That was the original cost of the book. The carriage inwards refers to the transportation cost or the shipment cost from the supplier's place to the customer's door. It will form part of the cost of the goods that were purchased. So taking the opening stock plus purchases, then plus carriage inwards cost, we should be getting a cost of goods available for sale. Returns outwards refers to the value of goods that have been returned back to the supplier after the purchases had been made. Then we also have the closing inventory. So now, when you pick the opening inventory plus purchases plus carriage inwards and then you less the returns outwards, then you should be having the cost of goods now available for you that you can sell. Then, for you to know what you actually sold, you pick the total value of goods that is available for sale, then you deduct the closing inventory because this is the value of goods that were never sold out. Now, if you pick the sales minus the cost of sales, you will end up with gross profit or gross loss. Now, after gross profit, then we are supposed to add other incomes. So we have got interest on deposit, we have got discount received, we have got commission received, we have bad debts recovered, things like that. There are several of them. So in each and every case, you will realize that you have got various kind of incomes that you will be adding into this account. And I will not guarantee that you will find all these ones that we mentioned here appearing in every circumstance. So each and every circumstance will depend on the kind of operation, that is being conducted by that particular business. After you shall have added the other incomes, then the next thing that you should deal with is the operating expenses. Now we have got some expenses that are not directly associated with the sale of goods. So this is where now you need to capture them. So we have got the insurance cost, we have transport cost, rent expense, salaries and wages, advertisement expense, depreciation, discount allowed, bad debts written off, etc. etc. Now, after you shall have done all that, you'll be having the gross profit here. This gross profit, then you add the other incomes, and then when you less the operating expenses, the end result should be net profit or net loss. From this point, the business owner should be able to know whether he or she is making profit or losses in the business. So this is why we were saying it is a statement that gives us the picture of financial performance of a particular business. And that's why it's called the statement of financial performance. And the performance that we are talking about here is to know whether the business is either gaining or losing. Now we are going to use another question. So I can read through the question so that we understand together and then we can go through it. The following information was obtained from the books of Abdul Hanan and Company. You are required to prepare trading profit and loss account and balance sheet as at 31st December 2019. Note, all the figures are in dollars. So that's a key point there, that all the figures that you see in this table are in dollars. Now, these are the items that you are being given from the trial balance of the books of Abdul Hanan and Company. So as you can see, we have got sundry debtors with specified amounts, accounts payable, cash in hand, furniture, motor car, purchases, sales returns, salaries, opening stock, motor car expenses. We have insurance premium paid on 1st October 2019. We have cash at bank, machinery, wages, general expenses, carried inwards, carried outwards, transportation in, owner equity, drawings, rent, and taxes. Then you also have got some adjustments here. The adjustment, we have closing stock. We have provision for doubtful debts at 5% of sundry debtors. We have depreciations for furniture and machinery at 10%. Commission of $3,600 has been earned but not received till the closing of accounts date. I believe this one is going to be a very comprehensive question that will help us handle a number of the transactions within the P&L and even the balance sheet, as is mentioned here. In our lesson 6, we'll be able to handle the balance sheet and we are going to use the same question. So for today, as we handle our lesson 5, we want to do only the bit of profit and loss account, or the statement of financial performance, which is also known as the income statement. So every time you're given a question of this kind, the first thing that you need to start with is making the adjustments. Use the adjustments on the information that has been provided first of all before you start working out. So we are going to have separate sheet for workings elsewhere. So we'll be having here workings. So we've been told about the closing stock, which is at $35. So that closing stock, we are not going to use it in the workings, but we'll wait. By the time we are computing the cost of sales, we'll put it here, the closing inventory. That figure will be used to get the cost of goods sold. So we can leave that one, then go to this one. Provision for doubtful debts at 5% of sundry debtors. So we need to adjust these sundry debtors. We need to make this adjustment based on the sundry debtors amount that is given. So how are we going to go about it? We are going to have the doubtful debts. Okay, just to give a brief explanation about these doubtful debts. The provision for doubtful debts is normally being made based on the prudence concept, which normally guides or advises accountants not to be so much optimistic of the future in terms of revenues. Accountants are trying to be a bit pessimistic of the future, that the future is not going to yield as may have been expected. So we try to put in some provision that we are not going to be able to recover all the debts that are pending for this business because of one reason or another. So in this case, we are being told that we put a provision to the extent of 5%. Whenever we are making a provision of this kind, that provision will lead into something called the bad debts expense account. So we are going to have two accounts being affected here. We'll have the provision for doubtful debts account, and then we'll also have another account called the bad debts expense account. So let us draw them and see how we can pass them under workings. Now the first one we can call provision for doubtful debts. We also have the debit side and credit side for this account, and this one we said should be the bad debts account. Provision for doubtful debts, 5% of sundry debtors. So we can have here 5% times sundry debtors, which is $52. 5% times that should give us 2,600. So this is the doubtful debt that we are having. When expenses go up, we are supposed to debit. So here we shall say, with the name of this other account, provision for doubtful debts. Provision for doubtful debts of 2,600. I'll leave it at that because of space. Bad debts expense account. Bad debts expense account, and their amount will be $2,600. Then we go to another one called depreciation for furniture and machinery at 10%. So we can also develop some accounts here. Depreciation on furniture account. Some would also prefer combining the two together, but for me, I would advise that we do them separately so that at least we can be able to understand how they are moving. And then you also have here provision for depreciation on furniture. So depreciation for furniture, it is important to indicate here, this one was bad debts. Bad debts calculation. Here we have depreciation for furniture, and this depreciation for furniture is done at a cost of 10% times the value. 10% times the value here is 3,500. So it is $3,500. $3,500. What is 10% of that? That would be 350, because it will cancel 1 0. So it will be $350. Depreciation for machinery. So it will also be 10% of the value of machinery here is $24,000. So we have $24,000, which gives you do away with 1 0 and it will be $2,400. So this $2,400 becomes the depreciation cost of machinery, and then we have $350, which is the depreciation for furniture. Now we want to pass these two in the ledger accounts. Now we have got depreciation on machinery, credit and debit, credit. Then we have here provision for depreciation of machinery account. So we already have the value of depreciation for furniture here, which is 350. So for under depreciation account, which is an expense account, we shall debit that. So we'll have provision for depreciation on furniture account, which is at 350. And then you come to this other end, you say depreciation for furniture, which is 350. Provision for depreciation, which is 2,400. if you don't know why we are debiting and why we are crediting at some point, then could you kindly fall back to our lesson 4 so that you can get a better understanding on the debiting and crediting. Now, because I don't want to waste another time again referring or building the concept that we have already done in the prior periods or in the prior lessons, that's why I'm trying to move with speed. So we have already identified that the depreciation account will be debited. The corresponding account will be credited automatically with the same amount. So this one we have depreciation account, depreciation for machinery. Depreciation for machinery account will be credited at 2,400. The other one here is commission of $3,600 has been earned but not received till closing of accounts date. So the bit of received here tells you about something under the earned. So number one, we are being told that the commission income has already been earned but not received. So this one is taking us back to the accrual concept, which states that incomes are recognized when they are earned and not when they are received, while expenses are recognized when they are incurred and not necessarily when they have been paid for. So this commission amount on accrual terms or on accrual basis, we shall recognize this commission. So we have commission income. Then we should also be having the accounts receivable. So let's check if we have got any accounts receivable here. We only have accounts payable here. We don't have, and we had some sundry debtors, but we can have a separate one called accounts receivable. When accounts receivable go up, which is an asset actually, then we are supposed to debit the asset. When the commission income, when income goes up, then we are supposed to credit. So here we'll say commission income, which is 3,600. And then here we credit by saying accounts receivable, $3,600. As usual, we are supposed to close down these accounts. So we can start by closing this one and say balance carried down 3,600. $3,600. Then here we'll say balance brought down, which is also 3,600. Here balance carried down, which is 3,600, and then you close it at that figure. This one that we are doing here, we had already done in our lesson 4. So you'll get much details on that. Balance brought down of 3,600. Then we close the upper ones too. We can have here balance carried down of 2,400. Then we close it at 2,400. Here we say balance brought down of 2,400. Then we come here and say balance carried down of 2,400. Close it at that point, 2,400. Accountants do not normally have much time in doing the calculations, and that's why you see at times you might be forced to work with speed and do this even without waiting for the ruler. Balance But when you are working like you are doing it for a given organization, now at that point now you have time, you can be able to do it in a decent manner. This one is the one that you use trying to rush and maybe to get more marks. Balance carried down 350. So this is 350. This other one is also 350. Now you have balance brought down, which we'll use in the succeeding period. Here you also have balance carried down of 350. Close it down at that point. 350. I must admit that there are several ways of doing these entries that we've had here, but the most appropriate one that takes you stepwise is the one that we have adopted here. So don't be confused when you get another book talking about something different. It is just the same thing as long as you are coming to the same answer. So here we have balance brought down. Here $350. Then we also close these ones. Have balance carried down, which is 2,600. Close them at that point. 2,600, 2,600, and then say here balance brought down at 2,600. Here balance carried down at 2,600. Close them at that point. 2,600, 2,600, and close it on this side. Balance brought down at 2,600. So we have done with the adjustments that were given there. So this one we'll use in the calculation of cost of sales. We can now develop the profit and loss account using these balances that we have here and also the ones that we had in the trial balance of Mr. Abdul Hanan and company. Now, we had said that we need to capture the name of the organization, which is here, Abdul Hanan and Company Limited. Then you say here, what is the name of the account? The statement is called Statement of Financial Performance. Statement of financial performance for the period ended. Can confirm that for the period ended 31st December 2019. 31st December 2019. And then we can have the sign of dollar. We can have here the dollar sign. So we have got some two columns here. So we are going to start by recording the amount of sales. Now we are just following this format and we'll just be putting down what we have. That which we don't have in this circumstance will be used in another circumstance. So don't worry about it. Let's move. So under sales, what do we have on sales? Just record. We just check first of all, do we have sales? Yes, we have the value of sales here, which is $292,000. So just record that we have sales amount coming to I think because we have got sales returns here that will be used to adjust then the value of sales. So let us capture it under this column, then we bring in the final figure on the column at the last. So you can have the value of sales here, which is 292,000. 292,000, and then you say less sales returns. So sales returns here is the same as the other word called returns inwards. $2,600. $289,400. Next here is the cost of sales. So look for the cost of sales. The cost of sales, we are supposed to start with the opening inventory. So do we have the opening inventory anywhere? You can see we have opening stock. So just write that, opening stock. We have opening stock amounting to 11,400. This is the opening stock, 11,400. So because we are still going to adjust, we can use this inner column, 11,400. Then the other thing is to add purchases. We can see there is purchases here. So add purchases. What is the value of purchases? We have $145,000. $145,000. Then the next thing is to add carriage inwards. Do we have carriage inwards? Yes, we have here carriage inwards. We have carriage inwards, which is 2,040. So add, this is the cost of transporting these goods to the premises of Abdul Hanan Company. The carriage inwards. The carriage inwards. So carriage inwards here will be $2,040. Then what is the next thing? You check here. We have already taken purchases and inventory plus carriage inwards. Then we are supposed to do away with returns outwards. Do we have returns outwards? Then you just check here. We have furniture sales returns, insurance, cash, machinery, general, carriage inwards, carriage outwards. Then we have transportation in. Now, I want to explain something here. The transportation cost that was incurred when making sales. So it is the shipment cost or the transportation cost of goods as they were being taken to the premises of the customer or to the customer's place. So that is what we call the carriage outwards. Now, in this case, we do not have goods that were returned outwards, as you can see. So what we need to go to, I said the one that you don't have to force or you don't have to fix your own figure. Just assume that, and then we go to another one. So how about the closing inventory? We should be having the closing inventory here. We were given an adjustment. So we are having $35,000. So say here less closing stock or inventory. $35,000. Then this one actually should be in bracket to show that we are deducting it from that total. Now, if you take opening stock plus purchases plus carriage inwards, that one should give you the total value of goods available for sale. So the total goods available for sale would be $158,440 minus $35,000. And then you'll get the cost of goods sold. So you'll have $123,440. So here is $123,440. This is the cost of goods sold. This amount you can transfer here and say we have 123,440. So this 123,440, when you deduct it, we are supposed to have something called the gross profit. 165,960. So you have 165,960 being a positive figure, then that one tells you it is a gain. So we are having gross profit. Now you don't write here gross profit stroke loss. Just write gross profit because it is an actual thing that you can be able to see. In case of any other income, then we can add them here and also charge the operating expenses so that we can end with the net profit or net loss. We have got this commission received. You can remember from our calculation here, we had commission income. So we can pick this one first and say here, add other incomes. Other incomes. So under other incomes, we have commission income. So this commission income, you just pick it here, which is 3,600. So 3,600. I'm putting it here expecting to get some so that we adjust before we take it to the final column. So we go to the trial balance that was given to see if we have got any other income. We don't have any other income. So the next thing that should come here is operating expenses. Operating expenses. Operating expenses. So under operating expenses also, we have got a number of them. A debtor, this one is an asset. Accounts payable liability, cash in hand an asset, furniture asset, motor car asset. Salaries is an expense, so we'll have salaries here. Salaries. So salaries will be 8,420. 8,420. And also remember, because this figure is alone here, just extend it this side. We expected to have a series of them, but unfortunately or fortunately, we now only have one. So that one, you extend it to the last column. Then we also have, we have picked salaries already. Motor car expenses, you can also pick that one. This one could be motor car repairs and maintenance of motor car. So you pick that one. The amount is 3,600. 3,600. That one is already done. Equipment is an asset. Insurance premium paid on 10th. This part here paid on 1st October 2019. Then you have to, this one calls for your attention to check where the period limits cut. What is the starting date? If this period is ending on 31st December 2019, it means that counting 12 months backwards, you are going to have January being the first month, then December is the last month. And this one is October, which is within the period. So it has been paid within the period. So that one is an expense that has already been paid. So it is not an accrued expense. So that one will just be captured here as insurance premium. Later on, I will explain how we can handle the accruals. And you'll be able to understand best what we mean by the accruals. Insurance premium. expense. So that one is, the amount here is 2,400. Then we are done with that. We go to cash, machinery. Those ones are assets. Though now we need to go to wages. Wages will be 23,600. 23,600. We are done with wages. Then we have general expenses. Which is 2,680. Then we have carriage outwards, which is like transportation. Carriage outwards. Transportation of goods to the customer. 1630. Then the next thing here, we have transportation in. Transportation in. Can say transportation in 6,430. That's also another expense. Owner equity, that goes to balance sheet. Drawings, balance sheet. Rent and taxes. This is another one. Rent and taxes, which is 3,600. Then remember, we had some that we had calculated under workings. So we had the bad debts expenses. We can capture that. Bad debts, which is 2,600 captured. Then we have depreciation on furniture. On furniture expense. That one will also be $350. Then we have another depreciation on machinery, 2,400. $2,400. So we have already captured all the P&L items. The ones that are left there will be used in the balance sheet. So we'll use these workings when we'll be developing the balance sheet in our lesson 6. Now we just need to sum up these ones. Now you bring this amount here, then you put it in bracket to mean that we need to deduct it. Then you will pick the 160, the gross profit plus the additional income minus the operating expenses. Our gross profit was $165,960 plus 3,600 minus 57,710. $111,850. So this is going to form what we call the net profit. Net profit. $111,850. So that is how we get the net profit. It is a statement that will enable us know if the organization is either gaining or losing. So as per the calculations that we've had as accountants, we can be able to say from the face of it that the organization is doing well. next time, as we are going to develop our statement of financial position, then we are going to use this one to adjust under capital. So I welcome you to the 6th lesson that will be handling the statement of financial position. When you come across a content that you benefit from or a content that is so useful to you, the best that you can always do is just to subscribe, maybe share and comment, just to also help champion the spirit of the person who creates that content. I know this one is going to several people in the world, and I welcome you. With me here, you are safe. I know we are going to go far with these accounting concepts, and we've just started with the basic ones. I know we'll be handling much more sophisticated questions that are even coming to the level of those who are taking the degree and masters, and even the CPA courses that have been taken to be the most difficult course. Here, we do not give any chance for a course to be difficult. So stay tuned, and if you want to have this information brought to you every time I post a video of this kind, then ensure that you click the notification bell just besides that subscription button. So thank you so much, guys, for your time. Welcome again. My name is CP Otieno. Thank you, everyone.